In this video, we are going to do a deep, detailed analysis of one of the biggest banking frauds to hit India in 2026, the 590 crore fraud at IDFC First Bank's Chandigarh branch. This case came to light in February 2026 and involves government funds from Haryana, insider collusion, forged transactions, and a money trail that stretched into shell companies, real estate, and luxury assets. No hype, no politics, just the facts, the financial loopholes, how it actually worked, the risks, and where the case stands today as of May 2026. Let us start with the background. On 22nd February 2026, IDFC First Bank made an official disclosure to the stock exchanges under SEBI regulations. The bank reported that during a routine account reconciliation at its Chandigarh branch in Sector 32, it discovered unauthorized and fraudulent activities. The accounts involved were linked to several Haryana government departments. The initial suspected fraud amount was around 590 crore rupees. Later updates showed the bank ultimately settled claims of 645 crore rupees. What triggered the discovery was simple. Haryana government officials wanted to close certain accounts and transfer the funds to another bank. When they checked the balances, the numbers did not match the bank's records. That one request exposed a massive hole. The funds in question were mostly government money parked as fixed deposits. Departments under schemes like the Mukhyamantri Gramin Awas Yojana had placed money in IDFC First Bank and also in AU Small Finance Bank. The idea was to earn slightly higher interest while keeping public funds safe. Instead, those funds were allegedly diverted through a network of compromised accounts. Now let us break down the exact numbers and timeline. The fraud surfaced on 18-20 February 2026 during internal reconciliation. By 22nd February, the bank publicly admitted the issue. The amount under reconciliation across 12 identified accounts was approximately 590 crore rupees. The bank suspended 4 employees immediately. Haryana government de-empaneled both IDFC First Bank and AU Small Finance Bank from handling government business. By March 2026, the bank had paid out 645 crore rupees to settle the claims and confirmed no further discrepancies in those accounts. Investigations revealed that the fraud involved at least 8 Haryana government departments, including panchayats, pollution control board, and power utilities. Some reports also linked parallel irregularities worth over 170 crore rupees in Chandigarh administration accounts. The deeper financial loophole here is classic insider collusion at the branch level. Here's exactly how it worked. Bank employees, in alleged connivance with external players and some government officials, exploited weak internal controls. Government departments had opened accounts and parked large sums as fixed deposits, offering unusually high interest rates, around 10% in some cases. Once the money was in, staff allegedly created forged checks, manipulated account statements, and routed funds through 12 compromised or dummy accounts. These accounts belonged to shell companies or intermediaries. The money was then siphoned out and used to buy real estate, jewelry, luxury cars, and even properties abroad. One key accused, a former bank manager, was reported to have acquired a Dubai flat, a 1.5 crore watch, and a BMW while earning just over 1 lakh rupee salary per month. The collusion allegedly involved bank relationship managers persuading officials to park funds and then diverting them without triggering alerts. Normal banking safeguards, multi-level approvals, real-time reconciliation, KYC re-verification for high-value government accounts were bypassed. Even though digital systems exist, the fraud happened through manual interventions and forged documents at a single branch. This was not a cyber hack or external attack. It was an inside job that stayed hidden until the government itself asked for the money back. The masterminds reportedly included bank officials like Ribhav Rishi from IDFC First Bank and Abhay Singh from AU Small Finance Bank, along with private individuals such as hotelier and real estate developer Vikram Vadva. By March 2026, at least 16 people had been arrested. The money trail led to jewelry shops, shell firms, and suitcases of cash. Haryana State Vigilance and Anti-Corruption Bureau and later the CBI uncovered how funds moved from government fixed deposits into private hands through fake firms. Now let us look at the real risks and citizen impact. This 590 crore IDFC First Bank fraud shows how public money, your tax rupees meant for rural housing, pollution control and development, can disappear when oversight fails. The scale is huge. 590 crore rupees is more than the bank's entire net profit for one quarter. IDFC First Bank's share price crashed as much as 20% the day after disclosure, wiping out thousands of crores in market value. For the bank, it was a major reputational hit, even though it ultimately covered the amount through insurance and recoveries. For the government, it exposed serious gaps in how public funds are parked and monitored. Haryana responded by tightening rules, deposits capped at 50 crore rupees per department per bank, and government money can no longer be parked in savings or current accounts. Several officials, including IAS officers and department superintendents, face dismissal or CBI scrutiny. The broader risk is loss of public trust. When public money in private banks can be diverted through simple insider fraud, it raises questions about safety of all public deposits. On the investigation side, the case is still very active. The CBI took over the probe with Haryana government's approval. As of May 2026, multiple arrests have been made, including key conspirators. Forensic audits are ongoing to trace every rupee. The Haryana government has dismissed several officials involved and is pursuing criminal conspiracy charges. The bank has cooperated fully and confirmed the issue was isolated to that one branch. RBI has called it a specific incident and not a systemic failure across the banking sector, but governance concerns remain. In summary, this 590 crore IDFC First Bank fraud is a textbook example of how discretionary power at the branch level, combined with weak reconciliation and collusion between bank staff, private players, and public servants, can create a dangerous financial loop. Public money parked for safety ends up funding luxury lifestyles instead of public welfare. The case proves that even in 2026, with all the digital banking tools available, human collusion can still bypass controls if vigilance is missing. The positive side is that the fraud was caught through routine government reconciliation, the bank disclosed it immediately as required by law, and recoveries happened quickly. But the lesson for all of us is clear: whether it's government funds or your own savings, constant monitoring and strong internal checks are non-negotiable. This fraud has already led to stricter rules in Haryana and will likely force banks nationwide to tighten branch-level controls on high-value government accounts. Public money must stay protected. That's the core message of this entire episode. Stay informed and stay alert.